Most traders still struggle because they see the market like retail traders, not like institutions. They focus on indicators, while smart money is moving the market behind the scenes. In this video, you will learn how to analyze your charts using smart money concepts, and how to combine the Wyckoff method with Munihisa candlestick patterns to make better trading decisions. Because if you miss this, you're missing a key piece of the puzzle in your trading. In this video, you will learn how to analyze any market using the Wyckoff method, how to identify smart money areas where traders get trapped, how to combine the Wyckoff method with Munihisa candlestick patterns, how to use what you've learned from previous lessons, candlestick patterns, support and resistance, market structure, and most importantly, how to combine all of these concepts together to build a powerful and complete trading strategy. Before we get started, if you enjoy this type of content, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss a new upload. The Wyckoff method is based on the idea that the market moves in 4 phases: accumulation, markup, distribution, and markdown. This is how smart money moves the market. Let's start with the first market phase, accumulation. In this phase, the market moves in a range and accumulates positions. Buyers and sellers are relatively balanced, but buyers are preparing to drive the market upwards. Once the market exits the range, we enter what we call the markup phase. The markup phase is an uptrend where buyers take control after the accumulation phase. Institutions that bought during accumulation now start pushing the market upwards. Once they start taking profits, the market begins to range again and then enters the distribution phase. Distribution means that buyers are taking profits. As the market continues to range, early buyers start to feel uncertain and begin selling. At the same time, new institutions enter with selling orders, and we see the market exit the distribution phase and enter a markdown phase, where sellers dominate the market. During the markdown phase, sellers push the market downwards, supported by new sellers who see the opportunity. So this is how the market moves according to Wyckoff. It is all about accumulation, markup, distribution, and markdown. Now, as a trader, how do you identify the end of the accumulation phase so you can ride the beginning of the markup phase? And how do you identify the end of the distribution phase so you can ride the market down? Please don't skip any part of this video because what you will learn can dramatically change your trading results. I will share with you concepts you may have never heard about. Look at this chart example. As you can see, the market was trending down and then entered a range. This is a clear accumulation phase. So how can you predict the end of this accumulation phase? Wyckoff introduced a powerful concept called the spring. So what is a spring? A spring is a trap that institutions use to trap retail traders before moving the market upwards during the accumulation phase. As you can see here, the market is still ranging, but look at what happens. The price breaks below the range and then closes back inside it. This is a clear spring. It represents sell-side liquidity that smart money targets before pushing the market higher. Now look at what happens next. The market exits the accumulation phase and starts moving upward, entering the markup phase. Now, look at another chart example. As you can see, the market was trending up and then it enters a distribution phase. This phase indicates that buyers are no longer buying. Instead, they are selling and taking profits. So, how do we know when the market will drop? According to Wyckoff, smart money creates what we call an upthrust. It is a buy-side liquidity move used to trap retail traders and make them believe that the market is only pausing and will continue going up. Once traders enter, the market closes back inside the range. This attracts institutional attention, and they enter the market in the opposite direction. And what happens next? As you can see, the market exits the distribution phase and enters a markdown phase. Now you know how to identify an accumulation phase and when it is likely to end after a spring, and how to identify a distribution phase and when it is likely to end after an upthrust. Now let's add another layer to the method so that you can be more confident in the move before it even happens. Look at this chart example. As you can see here, the market was trending up, which means buyers are in control, and then it enters a distribution phase. After that, an upthrust occurs. But look below on the chart, I added the volume indicator. You can find it on TradingView. It is a free indicator. Once the upthrust occurs, we look at the volume indicator to see if there is strong selling activity. And as you can see, during this buy-side liquidity sweep, volume increases and the red bar indicates strong selling pressure, confirming that sellers have entered the market. This confirms that new participants have entered the market, and this upthrust is a warning sign of the beginning of a new downtrend. Now let's go a bit more advanced. Do you know this trader? He is the inventor of Japanese candlestick patterns. He was known as the god of the markets. He made what would be billions in today's money trading rice using only candlestick patterns. Let's use his knowledge in combination with the Wyckoff method and the volume indicator to make better trading decisions. Look at this chart. The market was trending down, and then this candlestick pattern appeared. This candle is called the Tonkachi, according to Munihisa Homma. He was ahead of his time. He was drawing charts manually and identifying the Tonkachi before everyone else. And look at what happened next. The market moved up. Now look at another chart example. As you can see, the market was trending up and then this candle appeared. Munihisa Homma called it the Nagaraboshi. It was one of the most important candlestick patterns he used as a signal when he was dominating the rice market. Look at what happened next. The market moved down. Now, we will not use the Tonkachi and Nagaraboshi alone because if we do, we will destroy our trading account. Instead, we will combine them with the Wyckoff method. This strategy is simple and effective, so keep watching to learn how to trade like a professional. Now look at this chart example. This is the euro against the US dollar on the 5-minute time frame. As you can see, the market was trending up, which means buyers are in control, and then it enters a range. At this point, we don't really know if this range is a distribution phase or just a pause before the market continues higher. Now look at what happens next. The market breaks above the range and then closes below it, forming a clear Nagaraboshi candlestick pattern. Munihisa considered this a bearish reversal pattern, and when it forms at a potential distribution phase, it can be seen as a powerful signal. But look below on the chart. We also have the volume, which is very important. As you can see, the volume shifts to red, signaling strong selling pressure. This indicates that sellers entered the market immediately after the upthrust, providing a clear confirmation of a potential bearish move. Now, you can place your entry at the close of the Nagaraboshi, set your stop loss above it, and target the next key level. Look at what happens next. The market drops, exits the distribution phase, and continues moving down. As a beginner trader, I don't recommend entering a trade without a stop loss or a target. Since you are still gaining experience, it is better to define your entry, stop loss, and target in advance, and then let the trade play out without interference. You don't need to use multi-timeframe analysis, as this is not a trend-following strategy, it's a contrarian trading method. When the trade goes in your favor, you can make significant profits, and when it fails, you already know how much you can lose. As you can see, this trade provided a 6-to-1 risk-to-reward ratio, which is excellent. Now look at another chart example. The market was trending down, which indicates that sellers are in control, and then the market enters an accumulation phase. Here, sellers are no longer in control, as new participants enter the market, and there is equilibrium between buyers and sellers. So how do we know if this is an accumulation phase or just a pause before the market continues going down? We wait for what we call a spring. Look at what happens. As you can see, the market breaks below the accumulation phase and then closes back above it. This is a clear spring, or what we call a sell-side liquidity sweep. This candlestick pattern is what Munihisa called a bullish tsutsumi. He considered this pattern powerful because it shows that buyers have engulfed sellers. And when this happens during a liquidity sweep, it gives the pattern even more strength. Now let's look at the volume to see if it confirms our trade setup. As you can see, the volume indicator shows strong buying pressure, which means new participants have entered the market. This is a clear early sign of a potential market reversal. Now you can place your entry at the close of the Tsutsumi candlestick pattern, set your stop loss below it, and target the next key level. Look at what happens. The market reaches the target as expected. Now let me give you an important note. You can use different candlestick patterns as a signal once you identify a spring or an upthrust. Patterns such as the doji, tailed bars, piercing pattern, inside bars, evening stars, and morning stars can all be used. Feel free to check out my video that covers candlestick patterns in detail. Now look at this chart. As you can see, we have the 4 phases according to the Wyckoff method. Here we have the accumulation phase, followed by a markup phase, then a distribution phase, followed by a markdown phase. You now know how to trade the accumulation and distribution phases, so let's move on to how to trade the markup and markdown phases. A markup phase is simply an uptrend. When the market exits the accumulation phase, it enters an uptrend. As you can see here, we have a clear markup phase after accumulation. So how do we trade this phase? First, you need to understand the markup phase structure. Markup structure is characterized by two types of moves: an impulsive move in the direction of the trend, driven by buyers entering the market, and a retracement move, which occurs when buyers start taking profits. So when trading the markup phase, you want to take advantage of the impulsive move and avoid entering during the retracement. So the question is, how do you identify the beginning of the impulsive move and the end of the retracement during a markup phase? Look at this chart example. As you can see, the market exits the accumulation phase and is now in a markup phase. When the market makes a move upwards and then retraces, the point where the retracement starts is called a resistance level. It is a reference point in the market because this is the area where price was rejected by sellers and where some traders decided to take profit. Now look at what happens next. The market makes another move upwards, breaks the resistance level, and then pulls back. Once this level is broken, it turns into support, and it still acts as a reference point. When the market returns to this level, we can anticipate the beginning of a new impulsive move, and this is where Munihisa Homma comes in. We use candlestick patterns to confirm the end of the retracement and the beginning of a new impulsive move upwards. Here, we have a clear Tsutsumi pattern that appears and indicates the end of the retracement and the start of a new impulsive move upwards. So remember, during a markup phase, you identify the previous resistance level that was broken. You wait for a retracement back to that level. The resistance becomes support, and once the market reaches it, you wait for a candlestick pattern to appear. Now look at another chart example. During the markdown phase, the market exits the distribution phase and starts trending down. In this scenario, you first identify the end of the impulsive move and the beginning of a retracement, then you draw the support level. Next, you wait for the market to make another impulsive move and break below this support level. Once the level is broken, it becomes resistance. Then, when the market retraces back to this resistance level, you wait for a candlestick pattern to appear. This could be a pin bar, a tailed bar, or any other formation. The exact name doesn't matter. What matters is the signal. It must be a clear, bearish signal. This is your confirmation that the retracement has ended and that a new impulsive move to the downside is likely to begin. That is the move you want to trade. Look at what happened. As you can see, the market moved down. Now, an important note. When trading accumulation and distribution phases, you don't need multi-timeframe analysis because you are trading against the trend. However, when trading a trending market, whether up or down, you must use top-down analysis because you are following the new trend. Now, let's look at another chart example using multi-timeframe analysis. Look at this chart. As you can see, the market was initially in a distribution phase, meaning it was ranging. Then the market exits the range and begins a downtrend. Now, here's the key moment. Price breaks below a key support level, confirming bearish momentum. After the breakout, the market retraces back to retest the broken level, which now acts as resistance. At this level, a Nagaraboshi candlestick pattern forms. This pattern shows rejection from higher prices, sellers taking control, and the likely end of the retracement. This is your signal that a new impulsive move downward may begin. Since we are trading on the 5-minute time frame, we need confirmation from the higher time frame. So let's switch to the 1-hour chart. On the 1-hour chart, the market was trending up. It reached this level and reversed, forming a resistance level. Then, price came back, broke above it, and closed below it, creating a clear liquidity sweep. This indicates that the market is likely to reverse and move down, and that's exactly what happened. The market continued moving lower. This also suggests that price is likely to keep pushing down, meaning the higher time frame is aligned with our trading time frame, which supports our trade setup. Now let's go back to the 5-minute chart and evaluate the trade. We enter at the close of the Nagaraboshi candle. Our stop loss is placed above the rejection wick, and our target is set at the next key support level. This gives us a minimum 2-to-1 risk-to-reward ratio, which makes the trade valid. Now let's execute the trade and see what happens. As expected, the market continues downward and hits our target. Look at this chart. As you can see, the market exits the accumulation phase and begins forming a markup phase, which means buyers are now in control of the market. The market started forming higher highs and higher lows, and at this point, it broke above a key resistance level, which then became support. The market then retraced back to this level, forming a clear Tonkachi or a doji candlestick. The exact name of the pattern doesn't matter. What matters is the rejection. This rejection indicates the end of the retracement and the beginning of a new impulsive move to the upside. Since we are trading on the 5-minute time frame, we switch to the 1-hour chart. As you can see, the market was previously in a downtrend, and then it shifted into a strong uptrend, clearly indicating a trend reversal. This higher time frame confirmation supports our trade setup on the 5-minute time frame. Now let's go back to the 5-minute chart. We enter the trade at the close of the Tonkatchi candle. Our stop loss is placed below the wick, where buyers showed rejection, and our target is set at the next key resistance level. When we measure the trade, we can see that it offers at least a 2-to-1 risk-to-reward ratio, making it a valid setup. Now let's execute the trade. As expected, the market continues upward and reaches our target. One of the most common mistakes I see is traders trying to force the market into a perfect cycle. They think the market must always follow this sequence: downtrend, accumulation, markup, distribution, and markdown. But in reality, the market doesn't work like this. On real charts, things are not that clean. If you think this way, you will get confused and make wrong decisions. Let's look at this example. As you can see here, the market formed an accumulation phase. Then, we see a clear spring, after which the market exits the range and starts trending up, entering a markup phase. After that, the market enters another range. At this point, you might think, alright, I need to prepare for a sell because the market is entering a distribution phase. But this is not correct. Look at what happens next. The market breaks out of the range again. This is not a distribution phase, but another accumulation. In this case, you have two choices. Either wait for the market to retrace back to the accumulation zone and look for buying opportunities, or wait for a clearly established markup phase and then join the uptrend. Now look at what happened next. The market retraced back to retest the second accumulation phase, and this is your opportunity to join the new markup move. As you can see, the market moved up as expected, so don't make the mistake of following any method blindly. The market is dynamic, it doesn't follow fixed rules. As a trader, you must learn to adapt. The second mistake most traders make is ignoring the volume indicator. Look at this chart example. As you can see, the market was trending down, and then it entered a range. The first mistake traders make here is assuming that because the market has already moved down for a long time, it must reverse. So, when the market enters this range, they think it is an accumulation phase, and they interpret this rejection as a spring. But look at the volume below the chart. You can clearly see a large red volume bar, which indicates strong selling pressure. This tells us that buyers have not entered the market yet, and this is not a valid signal. If you take this setup without analyzing the volume, you miss a critical piece of information. Buyers are not interested. Now look at what happened next. As you can see, the market continued moving down and did not respect the supposed accumulation phase. If you don't use the volume indicator, you might think the method doesn't work. But in reality, what you missed is a key confluence factor, the volume. And with that being said, always remember that the market will not follow a perfect structure, so don't try to force it. Instead, focus on confirmation, use volume, and follow what the market is showing you, not what you think it should do. If you found value in this lesson and want to support the channel, feel free to like the video, subscribe, and turn on notifications so you don't miss the next trading lesson. Thank you for watching and see you in the next video.